Hi, Professor Barati here. I want to give you some teaching notes on the Clarkson Lumber Company. And so this should help aid you, give you some direction on how to do this case study. Basically, what the case study is looking for is your financial acumen, your approach to solving the problem. And essentially, this is a cash flow problem. It's based on the working capital needs, the net working capital needs of a company. I should say net working capital because that's just current assets minus current liabilities. That's a start, but it's really about the cash flow needs of the company, which includes the assets and long-term note payables that we have to pay with Clarkson. So in a case study like this, there's really no a right or wrong answer. It's basically your approach, your financial acumen, and how to approach coming up with this answer. So this is a combination of a cash flow analysis, a forecasting analysis, which we did cover our chapter, some ratio analysis, okay, and basically your knowledge between the relationships between our income statement and our balance sheet. And what we do is have to forecast our income statement for next year. Now, all of us will probably come up with different income statements, but if you have a logical methodology and then you flow that into your balance sheet, that's what I'm looking for, is the financial acumen behind your approach. And whether you come up with X or Y as far as how much money Clarkson needs is not really what this is about. So basically, to give you some tips, one, the company does need more external financing. Even though it's generating a profit and growing sales, what we as financial students need to know and learn is that profit does not mean cash. Profit does not mean funds. 99% of the companies who have a profit don't have that same number in cash. So as we know, a company generates profit. That is a measurement of revenues minus costs. That's all it is. How it translates to cash is where the cash flow statement comes in. And that is what we have to do for this case study, is figure out what this cash flow and how it impacts our borrowing. To ascertain why Clarkson Company is so short of funds despite its record of profitable operations. So that's one. We need to discuss and figure out why we're short of funds despite being profitable. And we didn't basically lose the money or waste the money. It is part of the natural working capital needs of our business. Mr. Clarkson's estimate of his loan requirements, decide what size loan the company needs. So we can't just say, in this case study, we need more money. We need to really figure out how much he needs. To explore the wisdom of proceeding with a rapidly expanding level of operations. So we need to know, three, do we have to expand so rapidly to basically run the risk of putting the company out of business? So read these 4 items before you start. 1, 2, 3, and 4. And what I'm going to give you is a good place to start here is the cash flow statement. The net increase in cash or decrease in cash at beginning of the year, cash at the end of the year for 1994, cash at the beginning of the year, at the end of the year for 1995. So basically at the end of 95, we generated $4,000 more cash to add to our cash balance. This $56,000 cash will certainly not be enough to generate our working capital that we need. So let's look at our working capital. Essentially, our net working capital starts with cash provided by operating activities, this line here. Due to our growth in sales, our net income went up $77,000 in 1995. Now, the projected net income for the projected sales for 1996, we are told in this case study, is $5.5 million. What we need to do is project what the net income is going to be. Increase in receivables. Notice what's really driving the $80,000 decrease from cash provided by operating activities is an increase in receivables, an increase in inventory, an increase in trade and accounts payable, and a slight increase in accrued expenses. When current assets, such as receivables and inventories, go up, net working capital goes down. It's counterintuitive. So when assets go up, basically think of it as assets go up, cash goes down. Therefore, we need financing to make up that difference. When payables and accruals go up, cash goes up. Therefore, we need less financing. Okay? So when accounts payable goes up, essentially means we're using our vendors' money to finance the receivables and inventories, which are going up. We're using our vendors' payables before we go to the bank and get external financing. Keep in mind, accounts payable is not subordinated. We don't have to sign a note. It's not legally binding. And we don't pay interest, although there might be some interest and penalties with vendors. But they're not subordinated, and therefore they're less risky if we pay them late. So receivables and inventories went up, which put a strain on our working capital. Our cash went down. In this case, payables went up and accrued expenses went up. That helped finance some of it. Then our investing activities, which is increase in fixed assets, property, plant, and equipment, went up by $126,000. Net cash provided by financing inventory. To finance the increase in our receivables and inventory, we use some of our vendors' money. To finance the rest of that, plus the increase in property, plant, and equipment, we had to borrow $330,000 more from the bank. We also paid down our term debt and our buyout debt, which we will continue to do. So what you have to do is basically project your income statement. And you can do that by looking at the percent of sales method. You know what your gross profit is based on a history. You know what your operating expenses are based on history. The problem then tells you, look at your receivables. Notice that the receivables are going from 10.4 to 13.7. That's an alarm as a financial manager. Receivables are going up as a percent of sales. Why? Because the number of collection days, our DSO, which is a financial ratio, is going up. Inventory turns are going down. They started at 6.6. They're going down to 5.4. That's a problem. You can use this 13% to project what your inventory receivables are going to be based on the 5.5 million. Again, you can use 13%, 0.7% if you like. You can do an average of the 4 years. The same with the inventory turns. You can project what your ending inventory is going to be. Here is the income statement. You can project 1996 as a year. We are told it's 5,500,000. We know what our ending inventory was for the year. From this number. Our total cost of goods sold, very important number here, and our gross profit. Our gross profit equals, in 1993, gross profit divided by net sales as a percent. 24.61. $24.23 as a gross profit. Let's see if I did that right. Gross profit divided by net sales, so 24. So it's been holding up. We've lost a few points here from 24.61 to 24.23. You can use an average, okay, which is 24.36, or you can use last year's. Again, I'm looking for your approach. Just explain what you used and your methodology. Here, I'm going to use an average. I'm going to say 23.36. So, gross profit equals net sales times 0.2326. I'm sorry, 24.26. That means our cost of goods sold is going to equal, as we know from accounting, net sales minus gross profit will be the cost of goods sold. Now look at turns. If we know that our turns are averaging based on our, you can take an average or use the first quarter. We're told don't use the first quarter because that's an aberration. Basically, the first quarter is a slower period for us, so that's going to distort the numbers. You might want to use an average of 6.6, 6.8, 6.7. Year-end inventory, based on year-end turns, you 6.5, 6.1, 5.8. You might want to use 6.1. Again, just use a method that makes sense. I'm not saying this is the right answer, the answer you should go, but if it's inventory turns, it's going to be cost of goods sold divided by the number of turns, basically equals 6.1. From there, you could plug in what your purchases are going to be, and that's going to help decide what your AP balance will be. So inventory turns for ending inventory is cost of goods sold divided by X equals whatever inventory turns number you want to derive, which is you can take an average of 6.5, 6.1, or 5.8, or use last year's number. Let's use last number, which is 5.8. So 4,165,700 divided by 5.8 is 718,224. Therefore, this plus that minus that will equal that. We can get up an estimate of our purchases. So this beginning inventory plus X minus ending inventory equals that. So 4,165,700 plus 718,224 minus 587 will give us, let's see if I did that right. That'll give us 4,296,924. Much higher than these years. From here, you can do your average AP balance on your balance sheet. Operating expenses. Operating expenses include cash salary for Mr. Clarkson, 85, 22,500 in the first quarter of 1996, so 22,500 times 4 quarters is 90,000. So he gave himself a raise from 1995, a $5,000 raise. So you could take last year's numbers as a percent of net sales and carry that over to 5.5 million and add 5,000 to it for his raise. I mean, that's basically what you have to do to figure out what your net income is going to be. Your interest expense, it's going to be a little difficult to figure out because you don't know. Well, it gives you the interest rate of the loan, so you could probably figure out the interest expense on the loan balances, but you got to know what the pay down of the loan is, and you can get that from your cash flow statement. So we're paying down the debt by 20,000 every month, every year, and so take the percent of the interest on the balance. Net property as a percent of sales, you can estimate what your fixed assets, property and plant and equipment will be. Exhibit 2 is the balance sheet. So interest is computed average outstanding loan balance at a rate of prime plus 2%. Interest is fixed at 11% for the outstanding balance for B. Interest is fixed at 10% times the outstanding balance for C. So you could project some kind of interest expense for the outstanding balance. So I would just schedule out your balance each month and project what the interest is going to be to come up with that. Now, on the balance sheet, they give us some tips. On the balance sheet, you can certainly use 7% here. You can use an average receivable here. You can figure out what your inventory is going to be based on what turns you want, so use your formula for inventory. Accounts payable, total liabilities as a percent of sales. Okay, 73%. But what I would do is, for 1995, I would go to the balance sheet. And take out the long-term notes and figure out what your current liabilities as a percent of sales are. So I would take the current payable and accrued expenses, okay, and figure out what percent that is of your net sales. And use that to determine perhaps what your accounts payable or accrued expenses are. Or you could use your days payables. Now, in the problem, Clarkson wants to go to paying a 2%, taking a 2% discount. If it's paying its vendors 54 days, there's no way we could take a 2% discount. Therefore, our payables, DSO for payables, which is the same as AR, DSO, our payables is not going to be based on 54 days or 51 days in 1995. In order to take that 2% discount, our payables are going to come down below 35 days. So if we're going to pay basically 2% in 10 days, and our best year was 35 days, essentially our average payable is going to be paid in 25 days. We're knocking 10 days off. So that means our payables is going to go way up. Our payables are going to go up, which means our working capital is going to go down. That means if you take a payables based on these purchases of 25 days, you could back into what your accounts payable is going to be. As far as accruals are concerned, they don't really tell us much what's in there. I would use this as a percent of sales. So I wouldn't use the total liability as a percent of sales. I would break my liabilities into current and long-term. Use the current portion to figure out what your payables are or your accruals based on a percent of sales. If you do that, remember in your case study to say you're not taking 2%. If you decide you want to try to take a 2% discount on your purchases, do not use old data because that wasn't taking a 2%. If you decide you want to take 2% on your payables as a discount, do not use this old data that I'm highlighting to come up with your payables estimate. You need to reconfigure your payables by using basically a DSO method to calculate payables based on 25 days or less. I recommend that. And I would do it both ways to see how well you do. As far as your term loan, stick with your 20 here for your term loan to come up with your projected balance sheet because that's what they've done here. The good thing is this note payable goes away. The term loan is at $100,000 here, so you might want to keep that on the books and come up with the projected balance sheet. Your note payable is, I would make that 0 on your balance sheet because you want to know how much money you're going to need. So basically your assets minus your liabilities minus your equity is going to basically be at a balance. And this will be your plug, how much money you need to borrow the bank to balance it out. Your net worth starts out at $449. The only thing that's really going to change that is if Mr. Clarkson takes a distribution, which I'm not sure the case study mentions. If it does, you want to reduce your net worth. So your net worth starts at $449 as your starting balance. And what gets added to net worth is going to be the estimated net income that you come up with. Take that estimated net income and add it to your net worth for your estimated balance sheet. That net worth will increase based on whatever profit you come up with. I would use this as a 0 for a starting point. And so therefore your assets minus your liabilities minus your equity won't equal. And basically this will be your plug. This should go up. If it doesn't, if it's negative, you did something wrong. If it goes down, that's fine. It means you don't need to borrow money. You just need to know why it went down. Explain to me why it went down and what drove it down. Again, there's no right or wrong. What we need to understand is how you forecast and your understanding of the relationship between the income statement and the balance sheet. Here's a percent of sales that can help you in Exhibit 3. Notice that some of these covenants, basically you could take averages, and some of them are good, some of them aren't that good. Return on equity. This might also help you. Current liabilities, high, low. Again, all this can help you. Now, let me show you this study here. Back in your text, page 88, I believe, that's what that says. AFN determines the extra assets and financings that will be needed for a firm to undertake a new project. This is going to help you a lot in your projecting how much funding is needed. Additional funding needed. AFN is a way of calculating how much new funding will be required, so that the firm can realistically look at whether or not they will be able to generate additional funding and therefore be able to achieve higher sales value. Determining the amount of external funding needed is a key part of calculating additional funding needed. This is exactly the approach for the case study. It's right here in your notes. Essentially, here's the formula. Projected increase in assets. You can do that, okay, by taking the balance sheet, the percent of sales method, or using the DSO to increase your AR, project your inventory, project your AP, project your accruals, and so on. You'll know what your assets are. 7% of sales are your fixed assets, so you know what your fixed assets will be. It says it right in the case study. You can use a different number and say, I'm not going to buy any fixed assets this year, but say that in the case study. Spontaneous increase in liabilities, not total. That's why I had you separate current and fixed and long-term, because long-term is set. It's fixed. You have an amortization schedule. You make your same payments every month. The amount you pay on debt doesn't go up because your sales go up or down. The amount you pay on debt is a set amount. So spontaneous increase in liabilities basically means your current assets, your accruals, and your accounts payable. Don't use total liabilities. As far as the assets, in this case, you're going to be using your total current and your fixed because they are going up. So it is your assets as a percent of sales, okay, which is the change in sales, not the total sales. So you got to take the 5.5 million minus the prior year's sales. So you want the change in sales, which is sales O. So the assets as a percent of total sales multiplied by the change in sales minus spontaneous liabilities as a percent of sales times the change in sales. Again, the 5.5 million minus last year's sales minus the profit margin times the total sales, not the change, but the total, times the retained rate. So the profit margin times the total sales of 5.5 million is going to be this number times what we retain, which is 1 minus the tax rate minus the dividend rate. In this case, we're not paying dividends because we're not public. Therefore, we're going to minus the tax rate. To save yourself the trouble, just take your income, net income, as that number, because this net income reflects net of taxes if you do it right. So if you take your net income and multiply the taxes, that will be net of taxes. You want to use that in this formula here. If this minus this minus this is a negative number, what that means is that the increase in assets due to an increase in sales can basically be financed internally by our own liabilities, current liabilities, and our own income, an internal income. So if our internal income and our increase in liabilities ends up being a negative when subtracted from here, we can finance our internal growth. If it's positive, that means that number means if it's positive, we need additional funds. Okay, so when our sales go up, essentially our assets have to go up to generate those sales. Remember, asset, return on asset. Remember, asset turnover. They're all functions of sales. So if sales go up, assets will go up. We have to figure out how to finance those assets. Remember, it's a simple, all comes down to the simple accounting equation. Assets minus liabilities equals equity. And you can manipulate that equation to find one of those three. It's really all based on that simple equation. So, if our sales go up, our assets likely will go up based on our return on asset ratio, based on our asset turnover ratio. When assets go up, liabilities minus equity, our balance sheet is out of whack. We have to either increase our liabilities or increase our equity or a combination of both. Our equity will go up based on our net income, less any dividends we pay. So that we can easily forecast if we know what our net income is going to be. The real trick is figuring out what our liabilities are going to be. If our liabilities don't go up enough and our equity doesn't go up enough, we either have to issue new capital from our equity section or borrow more funds from our liability section. That's all this is. It's a simple balancing of the simple accounting equation. When you look at it that term, it's really not very complex. What's complex is knowing that when sales go up, a lot of things move in motion. That's where the financial acumen comes in. That's what I want you to understand from this case study, is that when sales go up, things go out of whack. And they necessarily don't all go in our favor. We will have to borrow money. So try to work on this formula as well in your case study to justify what you already concluded when you did your estimated income statement and estimated balance sheet. This would be a second phase to basically justify that, yes, I feel that I am right. I have to borrow more money. If I plug in this formula, this justifies that I forecasted in the right direction. So all this is right in your text. So good luck with this. And I will send this video out to you as fast as I can. I'm sorry it's 34 minutes, but I think it will help you. I'll also put out an announcement that we can extend this case study, give you a few more days to process the video, and do a good case study. Thanks for watching. I hope this helps.